Guys, big earnings announcements this morning. We're going to go over 6 companies' earnings results. 2 of them I own. We'll go over those last. First off, Pfizer reported 60 cents in earnings per share versus estimated of 46 cents, so beating there, and then beat 13.3 billion versus estimates of 13 billion on the nose. Let's see how Pfizer is doing currently. It's up about 1%, nothing major. But guys, remember, Pfizer's at $31, all-time high, $61 towards the end of the COVID fiasco. And over 5 years, so this is before COVID, it's down 15%. Okay, Pfizer's a great company, pays a big dividend. So just keep that in mind. Stock number 2, Procter & Gamble, beat on earnings, missed on revenue. $1.40 per share in earnings versus $1.37 expected. Revenue of $20.5 billion versus $20.8 billion. So they missed there. Procter & Gamble, let's see how they're doing right now. Down 6%. Guys, for those of you who are interested in Procter & Gamble, take a look at this. I want you guys to remember, if you're new to watching this channel, I really don't care about short-term, quarter-to-quarter results, just if it's an affirmation of their plan or if something has materially changed in my thesis that I might be able to get a response from or get an indication from the earnings report. Company number 3, Merck, beat on both EPS and revenue, $2.28 per share versus $2.15 expected. $16.1 billion versus $15.8 billion in revenue. So again, they beat on both, down 6% also. Okay, so Merck's getting hit here. It looks like it's pretty close to its all-time highs. Yeah, June 25th of this year, just a little bit over a month ago, $134 per share. It's currently at $119, just like Pfizer. It's pharmaceutical. Got to look at that pipeline. Make sure you understand their pipeline. Do they have a lot of profitable and marketable drugs coming in the pipeline? It's not just about having a lot of drugs coming in. Do they have a lot coming in that they can market and make a lot of money on? That is what's key. Okay, SoFi, been the talk of the town for quite a while. If you're on Twitter and you've been watching SoFi, people are talking about SoFi, 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 SoFi. By the way, I'm very active on Twitter. Follow my Twitter account at EMPaulG. If you want to be able to engage with me, talk about it, see the things I talk about. Just yesterday, I posted about my Cybertruck is on order. So people out there, you can take a look at that. I reported today on the other 2 companies. I just commented on it, and I'll get into that in 2 seconds. They beat on earnings per share, 1 cent versus expected even, and beat on revenue, $597 million versus $567. Now, why is SoFi getting so much attention? Well, because they're currently at $7.56, but their all-time high was 28. That gets a lot of attention. It gets a lot of attention, as it should, when a stock is down a lot. The question is it still a reasonable price? Now, gross margin, not applicable. I don't know why that is, but they have a hard time making money. Free cash flow was pretty awesome last year, which might be a good indication. But remember, this is a company that makes loans, so you have to treat this differently than just some cash flowing business. That's what's most important on this company to understand before you go out there buying a company just because it's down a lot. You have to remember that the fundamentals, Peter Lynch always says, nothing is better than when you find a company that's down a ton, but the fundamentals are improving. Now, the next 2 companies I own, do not buy any company because somebody on the internet talks about why they have it. I'm here to teach my process. I want you to learn a process. If you're here to just get stocks handed to you to go buy without any understanding of it, you're at the wrong channel. I'm not the channel for you. Close it, move on. The bottom line is I'm here to teach a process. If you're trying to become a better investor, that you can sleep better at night, so you can make better decisions, not just in stocks, but in other areas of your life, we're the channel for you. So do me a favor and subscribe. That is what I'm here to do. Getting an indication in the short run because a stock goes up and down does not make you right or wrong. I have bought stocks where I sold them later realizing how wrong I was, and the stocks were up, and I sold them for a profit. Think about that for a second. I bought Carnival Cruise Line, and I bought Walgreens. And in the end, I made money on them after realizing how wrong I was on them. My thesis was completely wrong. It's just the short-term price movements of the stocks allowed me to exit at a profit. So the same goes on the flip side. Just as a stock is down does not mean you are wrong. Now, first stock, PayPal. This is the big one. $1.19 reported versus 96 cents, 7.89 billion in revenue versus 7.78 billion expected. This is the number 2 stock on the S&P right now. It is up 8.5%. Guys, this is a company that's down exactly 80% from its all-time high back on July 26, 2021, 3 years ago, almost to the day. It is down 80-some%. So if you believe that price movement makes you right or wrong, by the way, it was wrong here. PayPal was not worth $300 a share. But this would have made people say, look how right I am. Maybe so. And it'll be especially evidence in my next stock that I'm going to tell you, because I'm up over 3 times that stock in about a year, but I don't think it's worth it. But for PayPal, guys, PayPal had a great report. They're sitting there. Their metrics that matter are getting better. That's what matters to me in this report. That's what's most important for me in this report. Now, user growth has stalled and gone negative, but their per user revenue and per transaction revenue is increasing. That's what I love about PayPal. People are calling it a dying business. Well, let's see how dying they are. Let's go to their income statement. Let's go to quarterly. They just reported $7.89 billion in revenue. Same quarter last year was $7.29 billion. Is 7.89 bigger than 7.29? Check mark, yes. How is a dying business one that has increased revenue? They're focusing on better growth and more profitable growth. That's what they need to do. That's what every company needs to do. You don't need to be the biggest company in the world. Focus on profitable growth. The prime example I always give is Borders bookstores. They had 250 stores and were humming because that was the number of stores they should have had. But then they fell to Wall Street pressure and started growing and opening stores that didn't make sense. Now, the entire book industry did change, but Barnes & Noble's still around. And this company was on par with that. Now, next stock, Sprouts Farmers Market. Guys, not only did these guys crush, but they also raised their guidance. They reported 91 cents versus 78 cents expected, and they reported 1.89 billion versus 1.83 billion. This is the company that everybody's saying has beaten Whole Foods at their own game. They are up 20%. Go look back at my videos. I was buying at 32 to 33. Now, it's very important here. I want you to watch our video on the main channel at Everything Money on YouTube. We're going to put it out later this week where I'm going to do a thorough analysis on Sprouts. Spoiler alert, I don't think it's worth $100 a share. But guess what? I'm not selling it. I made that mistake with Microsoft 12 years ago. I bought it at between 17 and 21. It went to 60. I said it's overpriced. I'm selling it because overpriced companies fall eventually. Well, I learned that lesson that good compounders can keep going, and I don't know where the stock is going to go. This stock could fall in half tomorrow. I have no idea where it's going. But if it falls in half or falls back to 32, 33, do I think the company sucks? No, because I don't make my decisions based on price movement in the short run. I believe this company can compound at bigger rates. I believe this company is going to be a much bigger company a few years from now than it is today. Now, do I fear them being bought out? Yes, that'll stop the compounding for me. But this is a great company. They also raise guidance. That's a big reason why the stock is up so much. They raise guidance on this company. $100 per share, all-time high. Oy vey. The last 5 years, it's up 488%. Year-to-date, it's up 107%. The last 1 year, 160%. I mean, this company is flossing. But the price to free cash flow, 34. 5 years, 32. 5-year PE is 32. Okay. Just seems like a lot. It seems like it's a lot. But guys, that is what I'm here to talk about. I'm here to teach a process that makes sense to me, and you're going to pull different parts of it as time goes on. Now, we're doing a lot of videos this week because it's a super earnings week. So make sure you subscribe to this channel so you can get more earnings reactions. And in other weeks, we do market reactions when things go up, down, left, right. It does not matter. But the biggest thing we're trying to teach is focus on the long run. Don't focus on the short run. So guys, again, if you want to learn this stuff, subscribe to the channel. I appreciate your time.